Today, the Fed's much ado about nothing. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Today we heard from the Fed after their meeting, and the language was, well, still vague and I thought pretty unconvincing. In his press conference that followed the Fed decision, Powell said that the Fed's monetary policy actions have been guided by their mandate to promote maximum employment and stable prices for the American people. There was quite a bit of room to raise rates without hurting jobs, stoking expectations that the Fed's plan to tighten monetary policy measures, which has underpinned risk assets, may be more aggressive than expected. He said, "We understand that our actions affect communities, families and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals." But of course they are still buying more bonds, so are increasing their balance sheet, and did not change their interest rate target. As a result of all this, the S&P 500 closed lower on Wednesday as tech gave up some gains on surging US bond yields after he hinted that there was plenty of room to raise rates. And the first hike is still widely expected in March, although that wasn't clearly signalled by Fed. Powell, during the question session, is creating a bit of uncertainty. And I think that's why the market is reacting this way. He's talking about inflation might worsen, bottlenecks might get worse. What he's trying to do is to prepare the market for a worsening situation and also trying to balance the fear factor. But it seems the responses are creating an atmosphere of uncertainty, which is a negative for the market. He's talking about the Fed might have to use more tools. He's talking about the balance sheet reduction now. The bottom line is his response is causing the market to fear the uncertainty factor, said Peter Kramer, the Senior Managing Director at SLC Management in Washington. The S&P 500 fell 0.2% after rising about 2% intraday. The Dow Jones Industrial Average fell 0.4% and the Nasdaq was flat, having erased a 3% gain during the day. The remarks arrived after the Fed said in a statement that it may soon be appropriate to raise rates, and also confirmed plans to end its bond purchasing program in early March. With inflation well above 2% and a strong labour market, the committee expects it will soon be appropriate to raise the target range for the Federal Reserve rate, the Fed said in a statement. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy and that reducing our balance sheet will occur after the process of rising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primary treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach to balance sheet management in the light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. The Fed is a very slow-moving ship. By design, monetary policy has lagged anywhere from 9 to 18 months. The about-face we've had in terms of the market's rate expectations the last 3 months has been warp speed in the context of Fed decision-making. Expectations coming into this meeting were way too hawkish. The pace of which the Fed operates is measured in years and maybe quarters, but not months. We're going to see a much more measured pace of rate hikes. My interpretation of Powell is of a man who is not concerned about inflation running rampant, but one that acknowledges they had the transitory call wrong, not in terms of its nature, but more in terms of duration, said Peter Kramer, Senior Managing Director at SLC Management. US bond yields surged, putting a dent in growth sectors of the market, like tech, with the US Treasury yield continuing higher. And Microsoft, which was up more than 5% intraday, gave up some gains after the tech giant delivered an optimistic outlook on revenue following better than expected second quarter results. The bullish results from Microsoft helped steady sentiment on growth sectors of the market, including discretionary, following days of selling, at least during the day. Tesla reported on Wednesday that fourth quarter earnings beat analysts' forecasts and revenue. It topped expectations. They announced earnings per share of $2.54 on revenue of $17.72 billion. That's higher than analyst expectations. But Tesla shares were down 11% from the beginning of the year and still down 24.61% from its 52-week high of $1,243.49 set on November the 4th last year. They are outperforming the Nasdaq 100, which is down 13.16% from the start of the year, and Tesla shares gained 1.08% in after-hours trade following their report. Chipmaker Intel reported fourth quarter revenue, but its forecast for first quarter earnings fell well short of Wall Street's expectations. Intel shares, which were down about 3%, recovered some ground in after-hours trading. The world's largest chip maker forecast earnings per share of 80 cents compared to an expectation of 86 cents. And the outlook overshadowed fourth quarter results, which Tony Balow, Intel's Vice President of Investor Relations, said was a record and surpassed expectations. Adjusted revenue in the quarter was $19.5 billion, above an expectation of $18.3 billion, and adjusted earnings per share was $1.09, ahead of the 91 cents per share expected. We continue to see robust demand across all of our businesses, and then we see superb execution by our factory network, allowing us to go meet the demand in this challenging environment, Balow said. And the forecast places bets on its in-house chip-making capacity to meet strong demand from PC, data center, and artificial intelligence markets, even through a global semiconductor supply crunch. Intel, one of the few semiconductor firms that designs and makes its own chips, has been in a better position to weather the supply chain challenges. And last week, Intel announced it was investing $20 billion for 2 chip factories in Ohio that could eventually become the world's largest chip-making complex, with up to 8 factories. Elsewhere, Boeing was down 4%, having failed to join in on the broader market melt-up after the aircraft maker reported a wider than expected loss in the fourth quarter, and revenue fell short of estimates as the delayed deliveries of its 787 Dreamliner program hurt performance. Over in commodities, Brent crude oil prices breached the $90 level. That's the highest level since 2014, joining a broad risk-on Wall Street move and shrugging off a somewhat bearish EIA crude oil inventory report. Energy traders are anticipating higher energy prices on potential geopolitical risks, and as OPEC Plus will stick to their plan to deliver another modest increase to production at next week's meetings. Oil inventories posted a larger build than expected. Jet fuel demand plunged, gasoline imports dropped, demand improved slightly. Cold weather was behind the strong demand for heat. Crude production dropped again also, but that was mainly due to cold weather. And so far, earnings season from the oil giants suggests that will change going forward. Crude prices did not have much of a reaction post-Fed, settling slightly lower off session highs. Gold prices tumbled as equities roared back. The return of risk appetite dampened the appeal for safe havens, and that sent gold back to the middle of its recent trading range, just when gold looked as if it was going to break out. They pull it back in again. The path higher for gold is there, but it is likely that it will be a tough grind higher. Gold held on to losses after the FOMC statement laid out their plans for the March rate increase, and Powell's hawkish press conference sent gold to fresh lows as the Fed laid out the possibility of a much more aggressive balance sheet reduction and refused to rule out the potential of having an interest rate hike at each policy meeting. But there was some calm in crypto markets as panic selling of risky assets appears to be over, at least for now. Bitcoin steadied this week, and optimism is brewing in the cryptoverse that a strong altcoin session could be coming if Bitcoin can stabilize between $40,000 and $50,000. The regulatory hurdles, though, will remain a constant headwind for crypto markets. The crackdown on crypto companies that offer high-yield products appears to be heating up, as the SEC may be closing in on Celsius Network, Voyager Digital, and Gemini Trust Co. Many crypto traders have relied on these crypto lending products, and any disruption in their space could impact many coins. This decision by the Fed sounds like they're not convinced the time to hike will be in March necessarily, as they are leaving open room for consideration of monetary policy to adjust as needed. Keeping the balance sheet the same until hikes begin means they are indeed not taking all easing measures away quite yet. We thought there was a chance of this happening, and it could bode poorly for the dollar in the short term, said Juan Perez, senior foreign exchange trader at Monex. Now, just to give you some context, over in Chile, Chile's central bank enacted its largest interest rate hike in 20 years on Wednesday, lifting the benchmark rate there by a larger than expected 150 basis points to 5.5% as it seeks to rein in stubbornly high inflation. The central bank's board members voted unanimously for the move, according to a post-meeting statement. The evolution of inflation continues to face significant risks, and their possible materialization becomes especially relevant in a context where both the annual change to the CPI and its outlook are already high, the central bank said. Consumer prices in Chile jumped 7.2% in 2021. That's well above the central bank's target range of 2 to 4%. The move, which topped forecasts for a hike to 5.25%, follows a rate increase in December to 4%, from 2.75%, as the Andean country's economy rebounds strongly from the coronavirus pandemic and the government grapples with rising prices. Central banks across the region have actually been hiking rates to tame inflation. Brazil's central bank raised rates by 150 basis points in December and has signaled another hike in February. And Mexico's central bank, at its last meeting in December, also stepped up its efforts to rein in surging inflation, raising its benchmark interest rate by 50 basis points to 5.5%. And back in the US, the US Securities and Exchange Commission proposed on Wednesday new rules to boost hedge fund and private equity fund disclosures as it looks to increase oversight of the private funds industry and better monitor systemic risks. The private funds industry has drawn fresh scrutiny after hedge fund deleveraging contributed towards turmoil in the US Treasuries market in March 2020, and hedge funds were again at the center of last year's GameStop meme stock saga. We had issues and challenges in private funds earlier, and the transparency the US government had into it was scant at best, said SEC Chair Gary Gensler. The proposed changes to the SEC's Form Private Fund PF rules would require private funds to disclose details of material events within one business day, compared with the current quarterly or annual requirement, depending on the firm. Form PF, which was introduced following the 2007-2009 financial crisis, is the primary way private funds disclose purchases and sales of securities to the SEC. The draft rule, which is subject to public consultation before it can be finalised, would also lower the Form PF reporting threshold for private equity funds from $2 billion in assets under management to $1.5 billion to capture more firms. After almost a decade of experience analysing the information collected in Form PF, we have identified significant information gaps and situations where we would benefit from additional information, added Gensler. And separately on Wednesday, the SEC also proposed increasing the number of Treasury trading platforms captured by the agency's Fair Access Rule, which prohibits platforms from unfairly denying or limiting access to such platforms. President Joe Biden's regulators have expressed concerns over private funds' excessive use of leverage, which raises the risk that firms will not have the ability to absorb even modest losses when hit by adverse shocks. Last year, the Financial Stability Oversight Council, the FSOC, revived a hedge fund working group which President Donald Trump's administration had shuttered to gather better data on risks hedge funds may pose to the financial system. In 2013, private funds managed approximately $5 trillion in assets, but that number grew to approximately $11 trillion by the end of 2020, according to an SEC official. Wednesday's SEC measures would not see funds publicly disclose the new data, but would help regulators better spot signs of trouble, such as big losses, significant margin and counterparty default events, and other events associated with withdrawals and redemptions, the SEC said. Noah Theron of the Washington-based Managed Funds Association said that the group needed to review the proposal to ensure it does not ask funds to disclose routine activity. We support the SEC's broad goal of obtaining timely and relevant information from market participants in a crisis, he added. And David McGill at Cobre and Kim in Washington said the SEC will undoubtedly use the data to probe individual funds too. Ultimately, increasing reporting is going to lead to increased investigation, and nothing gets investors to run for the door faster than the government investigation. Those practical realities provide plenty of motivation for funds to push back here, McGill said. So, if you stand back and think about all this, the Fed really didn't say very much at all, despite some amping it up, and they are leaving the door very flexibly open to a range of possibilities. I'm not sure how quickly they'll start lifting rates, but I suspect it will be slower than many are expecting. And more broadly, the regulation of the financial system and financial markets, and particularly hedge funds, is something which is still a significant gap, and more needs to be done. But, as I said earlier on, this is really much ado about nothing at the moment. And in the meantime, I still think markets will slide a bit lower from where they are. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.